Dear learners, welcome back to another video on ratio analysis. I'm Lisna Jose, and in this video I'm gonna talk about debtors turnover ratio. Most of the business activities involves both cash and credit transactions, right? Without offering these credit facilities to the customers, the organization find it very difficult to expand its business or commercial activities at their expected level. Credit is one of the important element of sales promotion. The volume of sales can be increased by following a liberal credit policy. So when an organization selling goods or service on a credit, their payment are postponed to some future dates, then these debtors or receivables are created or arised in a company. This receivables means the amount owed to the firm as a result of sale of goods or service in the ordinary course of business, or in other words we can say that it is the claim of a firm against its customers and form a part of current asset. And receivables are also known as accounts receivables, trade receivables, customer receivables or book debts. These trade debtors or receivables are expected to be converted into cash within a short period of time so that it is included in the current asset part. Hence, the liquidity position of a concern to pay its short-term obligation in time depends upon the quality of the trade debtors or quality of the receivables. This debtors turnover ratio indicates the number of times the debtors are turned over during a year, or in other words we can say that debtors turnover ratio indicates the velocity or speed of the debt collection of a firm. And this debtors turnover ratio can be calculated by dividing net credit annual sales by average trade debtors, and we can calculate this average trade debtors by adding opening trade debtors plus closing trade debtors divided by 2. This trade debtors part includes sundry debtors and bills receivables and the accounts receivables. And you may take a note that debtors should always be taken at gross value. That means no provision for bad debts or doubtful debts are deducted from the debtors. Suppose when the information about opening and closing balance of trade debtors and credit sales are not given. So in such case or in such circumstances, what we will do? The debtors turnover ratio can be calculated by dividing the total sales by the balance of debtors. Now we will see how we can interpret this debtors turnover ratio. Normally there is no rule of thumb which may be used as a norm to interpret the debtors turnover ratio, because as it may be different from firm to firm depending upon the nature of the business. As we discussed earlier, this debtors turnover ratio or debtors velocity indicate the number of times the debtors are turned over during a year. So higher the value of debtors turnover, the more efficient is the management of debtors or sales, or more liquid are the debtors. Similarly, the low debtors turnover implies the inefficient management of the debtors or sales and less liquid debtors. So this is how we can interpret the debtors turnover ratio. Now we will see the another concept here, that is average collection period. And this average collection period shows the average number of days for which a firm has to wait before its receivables are converted into cash. And it can be calculated by using the equation days in a year divided by debtors turnover ratio, and if 365 days are taken, then you can calculate average collection period by dividing 365 by inventory turnover ratio. And how we can interpret this average collection period? It is just opposite to the debtors turnover ratio interpretation. Here, the average collection period ratio represents the average number of days for which a firm has to wait before its receivables are being converted into cash. It measures the quality of the debtors. Generally, the shorter the average collection period, better is the quality of debtors, as a short collection period implies quick payment of the debtors. Similarly, a higher collection period implies the inefficient collection performance, which in turn it will adversely affect the liquidity or short-term paying capacity of a firm. So this is how we interpret the average collection period. And now we can work out a simple problem. Here, annual credit sale is given as 25,000. Then sales return is given as 1,000. Then debtors is 3,000. Then bills receivable is 1,000. And you may find out debtors turnover ratio. And we know that debtors turnover ratio can be calculated by using formula, that is net credit annual sales divided by trade debtors, right? Trade debtors. And net credit annual sales means you may deduct sales minus return, right? And trade debtors means it includes debtors plus what? Bills receivables. So here how we can calculate? Here sales is given as 25,000, and at the same time there is a sales return, that is 1,000. So you need to deduct that. And coming to debtors part, it is given as 3,000, and also we have the bills receivables, that is 1,000. So what is the answer? It is 24,000 divided by 4,000, right? And the final answer is 6 times. And what does it indicate? 6 times the debtors are turned over during the year. This is how we interpret this ratio. So this is all about debtors turnover ratio. In the next video we will see what is creditors turnover ratio in detail. Till then, keep learning. Thank you.